Hello and welcome back into this lesson. So we are still looking at the strategy in gold, whereby we are looking for setups originating from the daily and the weekly fair value gap. Remember, the first step to this strategy is identifying this daily or weekly fair value gap and outlining it and waiting for the market to hit this specific area. So that specific area is our key interest, and from this area we'll be looking for some form of liquidity, either the buy stop or the sell stop, to be run in regards to the direction that you have that fair value gap. So first we are going to look at the weekly chart, and from the weekly chart we see, or we can outline, this weekly fair value gap. So we had the first weekly fair value gap, but we'll be looking at this second fair value gap, which was hit. So from there we want to go deeper into the daily chart, and at this specific weekly fair value gap we just want to narrow our focus into the daily chart to look for a specific, or for that specific daily imbalance that we can find close or in that weekly fair value gap. And we have a couple of them. So we have this first fair value gap here in the daily chart. Then we also have this second fair value gap here in the daily chart here. So you see that the bodies respected the first imbalance inside the weekly fair value gap, but also we hit the second fair value gap in the daily chart, which is also okay since it's also close by to this weekly fair value gap. So this is what we can anticipate, that sometimes it may hit the first or the second depending on the order flow. And remember, you cannot force the market to not hit the second and just to hit the first one. We just have to wait and see. Our aim is to wait and see what the market is doing. So after that, we establish that from the weekly chart, since we broke market structure upwards, we conclude that the order flow is bullish. And from that order flow, we see that we also created a new imbalance here in the daily chart, which shows continuation of order flow in the daily chart. So this shows that the weekly has potential of running higher towards maybe new weekly highs. So if we look at the weekly chart again, we see that now this is the first weekly target, but we also, so this is the buy side liquidity, but we also had this weekly imbalance, not weekly imbalance but weekly high here, the first one. So depending on where we are at the market, this should be our target. But we see that during this week, as we opened on Monday here, on Monday we did not have any imbalance since we had come off this daily imbalance, but our agenda of the market was to continue running higher to this weekly buy side liquidity, which we did. Then we see that we fell short of this buy side liquidity. And how do we know that market will continue running higher to this buy side liquidity? It is when we see that we have come close to running this high, but let me say market makers have left this buy side liquidity intact purposefully. You can see that it's just purposefully that we have not run into these highs yet. So from there we acknowledge that this imbalance in the daily chart will continue to push market higher to new highs and towards also new weekly targets. So from here, remember from the daily chart, when you narrow our focus into the lower time frame, we'll be looking at some form of sell side liquidity, since it's an imbalance, which is discount array, which is pushing market higher. We anticipate that some form of sell side liquidity will be run, and if this was a premium array, this imbalance would be a premium array, then would anticipate buy side liquidity to be run. So here we anticipate sell side liquidity to be run in form of, it can be previous day's low, but remember that this previous day's low is not limited to, does not confine us to yesterday's low only, but it is any low in regards to daily low. So from here we'll go into the 4-hour chart, and in the 4-hour chart we see that we have some form of liquidity here. So not much is going on in the 4-hour chart. We see also that we fell short of this liquidity that we were speaking of in the daily chart here, this high. So that's what's in so if you see this sign, this is a sign to show you that the price will continue to rally higher after seeking for discount prices. So from there we go into the 1-hour chart, and in the 1-hour chart we see that we ran the previous day's low on Thursday. So as I said, previous day's low is not limited only to the yesterday's low, like today being on a Thursday. It's not limited now to just being Wednesday. So we see that there are form of Tuesday's low which was run, which is okay, and this is actually what we want to see. So from this, let me outline this sell side liquidity. So this sell side liquidity, this is now the sell side liquidity that we want to see the market running and clearing some form of sell stops. So this is what we want to see, sell stops being run, and we see that there was engineered liquidity here, this swing low which was engineered again. So multiple run of liquidity, which is also okay. Then after that we have to ask ourselves if there's any confirmed break in market structure. So if I outline this is now the break in market structure. So remember, every trader can consider different areas as their point of break in market structure. So some may consider it to be here, or others here, as I have done. But what I want to see, in my opinion, is a run through with bodies. So a confirmed run above with a closure of bodies running above that break in market structure. Because if you see here, for example, when this candle printed, we did not have a closure above it with bodies, but it was only wicks. So for me, I feel like when I see this kind of scenario, it shows me that there's a potential that this might be it may be a run on stops, but you just have to wait for a confirmed break in market structure. Then after that, we now, depending on the entry pattern that you are looking to use, either the breaker, imbalance, or the order block, you just have to wait for a retest. So in this scenario, these two candles here, they are order blocks here because we had a change in state of delivery. Also, for anyone who is using the breaker, now this area, this up close candle here, before the market trend stops, is now our breaker here. So this up close candle here, before this run on stops, then a rally away, is our breaker. Remember, I said that this is our order block after confirmed change in state of delivery. We also had this order block here, which was confirmed by a change in state of delivery. So we just have to wait for a retest. So depending on what you trade, you just have to wait for the entry technique that you know that you use to trade. But during this entry pattern, I like to look at the two, either the breaker or the fair value gap. So in this case, we just have to extend, like the breaker, you just have to extend it. We see that we did not get a hit into this breaker, which is okay. And the reason for that is because of this, I think there are three consecutive imbalances which were formed. So when we get such a scenario where we have 3 consecutive imbalances at the break in market structure, what should come to your mind is that you should use this imbalance, the first imbalance, to enter or re-enter into the market, and it shows that there's a high probability that the market will not go down again. So this being our first imbalance, and also we have this second imbalance here. So if you notice, this example is different from the other examples that you have been looking at. And remember that price or the market has different ways of printing in the market, so you just have to identify these ways. So remember, also at the retest, we wait a retest during the session zone, a confirmed retest, which we should enter during the session zone, either the London or the New York session. So these sessions are the highly recommended session because I've not practiced. Let me say honestly, I've not practiced with the Asian, but I think in some cases the Asian session do work. But I highly recommend the London session or the New York session. So what time was this? So this was 4 a.m. on Friday, which is London session. This is 5, this is 6, this is 7. So we consolidated inside this imbalance up to the New York session here, and after we now got a rally above towards the liquidity, opposing liquidity, where the market is still continuing to fulfill its weekly objective. So in this instance, we see that for our stop loss, we have to use this second imbalance because we have multiple imbalances. We have actually 3, but remember, always use the first imbalance, from the imbalance that is closest to price, to enter. And then for the stop loss, I would recommend using the second imbalance here. So this would be your stop loss. This ideally would be the stop loss that you would use, and we should not see price coming to back below this imbalance. So if we see that price is coming below, seeking even this that imbalance, yes, sometimes it may do so, but it's low probability for price to come back down here. So this, as I said, should be our stop loss. And if you use the fib tool for targeting from this high to this low, remember, our first target would be this daily high, actually this one in the daily chart. That would be our first target. And remember, for targeting, you should not just exit at random places, because you should, for other trader, in short, you should see that price has come to hit your risk to reward ratio, because the aim of the market when we are entering or exiting is to capitalize the risk by earning a good reward ratio, and the minimum which I recommend is 1:2. So if, for example, you are aiming for 1:1, there's a high probability for a slow growth process or a slow curve in the growth in your chart, in your trading career. But if you target for 1:2, this has a high probability of increasing even your growth curve or your growth ratio here. So for example, if we had this long position here at this time, and our stop loss would be here at the low of this imbalance, then we are supposed to aim for this as the first imbalance. But I think the first thing I ask myself is, does this equate to 1:2 for the reward ratio, which is no. So I aim to increase till it reaches at least 1:2. Then from this 1:2 is when I can aim to close my partials. And if you remove like 80% of your trade or of your profits, then you have to also decide where next the market may target. So this is something that you should just ask yourself if you are comfortable with, but I can say that with time you'll be able to know when you can hold up to 1:3 or 1:4. So the reason as to why in this case I would advise to exit at 1:2 is because that this is on a Friday, and we see that since Monday we've been making higher highs. So this expansion in the weekly chart has been happening since Tuesday. So since Tuesday we have been rearing higher, creating the weekly highs and the weekly range. So there's a high probability on this day, on Friday, we won't get a very large expansion. And you also have to ask yourself if you're comfortable holding trades over the weekend. So if you are okay, then that's okay, but if not, then just know your limitations in this. So we hit the 1:2 target on Friday, and we ran also above these highs, the targets, and also the standard deviation 2 here. So this is standard deviation 1 from 0.0 to 1 and from 1 to 2. So the same measure of this range, however ticks it may be, from this 0 to 1, is what you want to reciprocate higher, and even higher if we are looking for higher prices, up to 3 or 4. But sometimes you just have to use the liquidity to be able to gauge if this standard deviation is a high probability for you. Yeah. So another thing I'd like to comment about this example is how, or if you are using the breaker as your entry model, you just have to know when to anticipate the market to hit the high of the breaker, and when not. So when not is when you have an example of this imbalance. That's when you use the imbalance to enter your trade. But if we would have one imbalance which is near the breaker, then it would have a high probability of hitting. But you see here we have 3 consecutive imbalances, so you use these imbalances for your trade, to enter your trade. And you also see the order block was not hit, so let us look at this other order block here. These 2 candles, they are order blocks once we confirm a change in state of delivery. But we also see again that these order blocks were not hit as we capitalized on the fair value gap. Yeah. So that's it for this lesson, and I hope that you have gained much from this example because it's different from the others. Yeah. So thank you for listening, and I wish you all the best in your trading career.